Hello and welcome to KYC. I'm Harsh Saita, with me is Puneet Javeri, and today we're going to be talking about Lumax Auto. Why is this one interesting? One is that the stock is up 30% in the last 5 trading sessions. So it's seen a massive rally over the last 5 sessions. Of course, very strong Q4 numbers, but the commentary seems to be stronger, and the goals for FY31 seem to be audacious. We're going to try and break down as to whether those are achievable and of course speak with management as well. But first off, what I want to understand and what I want to know with regard to where Lumax Auto is concerned. First off, I want to know what will drive the sharp growth that they've guided for. They've guided for a near 6x in terms of top line in the next 6 years. Can they actually do that? And what within the product category will actually drive that kind of sharp uptick in growth? The second one is they've also guided for better margins. So they're expecting margins to go from the current 14% to nearly 20%. Can they do that? What will the levers be? What will the product segments be? And how likely is it that they will achieve that kind of number? You know, that's the other piece I want to understand. The third one is with regard to how the business is shaping up and how possibly competition will also look. The other piece is with regard to acquisitions, of course, on your screen. Funding, ticket size, businesses, what's the type of acquisition they're looking at, because the top line will likely be at around 10 to 11,000 crore. The balance of the top line will be contributed by new acquisitions that will be coming through. We will talk about the company because that will be critical as well to understand. Will cyclicality impact the business? This is, of course, an auto business, and therefore, when growth in auto slows down, whether it's two-wheeler, three-wheeler, four-wheeler, which is PV or CV, you will likely see cyclicality in the business. Will that impact the numbers as well? Or is this 19,000 going to be steadily, or rather, will the company continue to inch steadily towards the 19,000 crore number? Despite the 30% uptake that we've seen in the stock, is 27 times earnings, that's what the current price to earnings ratio is, looking reasonable? And we'll hopefully try to answer that as well. So we'll try and get answers to all of those and help you, of course, dissect this better. Let me start off first with what the company does. It was incorporated in 1981. It's a leading manufacturer of gear shifters and interior solutions in India within the auto component side. Now, what are gear shifters? Typically, when you're driving a car, there's a gear that you use to drive the car, especially the manual ICE engine vehicles, and that essentially allowing the transmission to happen from one gear to the other is what a gear shifter is. It allows for the vehicle to shift gears. Is that right, Puneet? Is that the right explanation?
Well, definitely, and it's one of the key aspects and key business performance of the last 3 decades. So definitely, that's exactly what it is.
Correct. Perfect. Okay. So I've explained that properly. Let's look at now, therefore, how the product split is for the company as of FY25. The product-wise split, it contributes, or rather PV contribution is the largest at 53%, and we'll talk about the customer cohort as well that they cater to. 2 and 3 wheelers is just 22%. The aftermarket is around 11%. You have CV at 8% and others at 6%. So that's how the revenue split is in terms of products. Let's also look at brands that they cater to, or companies that they cater to in terms of customers. Look at those: M&M, Bajaj Auto, Maruti. You also have Honda, Tata Motors, and many others which they cater to across the board. That's largely how the revenue or the money that the company makes comes from. So that's how it's split up. Let's also talk about partnerships. They have partnerships with 7 companies. All of them I'm going to quickly flash on the screen so that we can quickly go through that. You have seat structures, you have air intake systems, as well as other plastic injection blow molded parts. You have oxygen sensors, which they deal with, and they have different partnerships with different companies across the world to manufacture these in India through subsidiaries with these companies. So it's not just that the company is giving them IP. The company has actually collaborated with a Lumax Auto in India to manufacture some of these parts. These are companies from across the world, from US, Italy, Japan, to Spain, Germany, and the like. So you've got all of these companies which they've tied up with. Let's look at the order pipeline now. At around 1300 odd crore, the split is going to be, or the execution is likely going to be like this. It's on your screen. So currently, that's how the order pipeline is shaping up. And they've made acquisitions, including the likes of a green fuel, to try and diversify away from the traditional ICE engine, which is the internal combustion engine. They're trying to also make a mark with regard to green products, and therefore that's how it stacks up. Puneet, your view with regard to the business itself of Lumax?
Well, definitely. I think that's one of the bigger aspects, because the company's market cap, when you see roughly between 5 and 6,000 odd crores, that also has been triggered by the latest stock move. But in terms of business performance, I think the company's really expanded with acquisition in the last 3 years. And as you rightly said, green fuel will help the company get into alternate fuel, that's CNG specifically. That will help the company in that aspect. And of course, when they acquired IAC in 2023, I think that was the turning point. We are seeing those effects, both of those combined effect in the 2025 numbers.
Okay, I want to quickly just pull out the graphic where you have the various products, and I want to also call out aftermarket there. The aftermarket opportunity is generally the second-hand opportunity. I missed explaining that. It's the second-hand opportunity even within the auto components
and
basket.
Very high margin also.
And it's a higher margin in terms of the way that product is handled. So okay, so that's how Lumax Auto stocks up in terms of the business itself. Now let's talk numbers. Let's quickly first look at the metrics that we will analyze, Puneet and myself, and let's try and see what all we'll be looking out for. One will be the income statement, the balance sheet, cash flow, return ratios. We'll also look at street cred, shareholding, outlook, and the valuations. Outlook is important because the guidance is extremely strong. Now, I want to quickly go across to Puneet. Income statement.
Well, definitely. You know, it's a very, very strong income statement number for the company. Almost 34% CAGR in terms of revenue over the last 3 years. And I just mentioned the IAC acquisition in 2023, green fuel they've done in 2025, and they've also now completed IAC. They had 75% stake in 2023. They've also acquired another 25 now, so it's 100% now owned by the company. It's reflective in the strong performance over the last 3 years. Post-COVID, of course, the first couple of years for most companies in the auto space were about stabilization, but the last 3 years it has been very strong for these auto and companies, and Lumax Auto is definitely one of the key beneficiaries. 40 to 45% in terms of EBITDA, as well as a 41% CAGR in terms of profits. So definitely a big thumbs up, Harish, on the income statement.
Yeah, and it's an impressive looking income statement. You're seeing margin expansion happen. You're seeing good, strong top line growth happen. So no reason why one should be concerned. Question will always be about sustainability of some of these numbers on the higher base. Let's talk about the balance sheet now. When you're looking at the balance sheet, your equity shareholders funds sitting at just roughly sub 1,000 odd crore. So you're looking at around a 6 times price to book in terms of valuation as well. What you're looking at in debt is you're seeing the debt go up around 400 odd crore in terms of debt, but the net debt number is low. So therefore no concern there. But the overall debt has climbed a little bit over the last couple of years. Would want to understand the outlook. They're also making acquisitions and the free cash flow is improving. So therefore, maybe there's scope for this debt to drop. But nothing significant on the debt front, because a 6,000 crore market cap company sitting at around 400 to 450 crore of debt, and therefore not really a concern. They've got around 100 crore of cash sitting on the balance sheet, 80 crore to be precise. So a thumbs up with regard to the balance sheet as well. No concerns. Puneet, cash flow.
Well, again, another cash flow. Now, when you look at cash flow, it's very interesting, because while the cash flow from operations have steadily grown over the last 3 years, they almost minted 300 crores of free cash in FY25. that's grown at 49% CAGR. The net cash flow from operations has been slightly disappointing, but that's largely led by the company's higher investments over the last 3 years. So FY23, they invested, the cash flow from investment specifically was almost 400, upwards of 450 crores. Then in 24, it was almost 250 crores and another 200 crores in FY25. Largely, that seems to be, in terms of investments, largely the bigger numbers seems to be done. Of course, some more may come in now, but with the increasing cash flow from operations, the net cash flow number should definitely get benefited, Harsh, going forward and should see meaningful improvement. But for now, we've given it a neutral rating.
Right, so we'll hold that as a neutral. Let's look at the return ratios as well. You see the way in which it's inched up from the 10% number to the 21% number. That kind of shows the way in which growth has come in, margins have kicked in, and also you're seeing operating efficiency starting to kick through with regard to this one. So you're seeing that ROC is actually inching up in a nice fashion. Their goal is to continue to clock that 20% ROCE number, so just want to flag that off as well. It's a thumbs up with regard to return ratios because all the fresh capital that's being infused is largely being infused to good return ratios, and that's the positive. Shareholding, Puneet.
Well, shareholdings, again, not too many complaints, Harsh, because, it's been largely stable at the promoter holdings of upwards almost 56%, while we've seen an increased participation from the public investors as well in Lumax Auto. We've seen in terms of shareholding, it was currently around 22%, but it has been steadily increasing over the last 4 quarters. Almost 4 quarters ago, it was 20.7%. So public investors and retail investors definitely liking the stock. What's interesting is that before that, it was almost 18.5% in 2023. So from 18.5% 8 quarters ago, almost 22.61% in terms of public holding has been very strong for the company. And domestic investors also have largely just slightly trimmed their stake, and that could be some, actually, when you look at it from the last year perspective, it's gone from 14 to 16% again. So definitely, again, a big thumbs up on promoter holding as well as increased retail participation.
Okay, Puneet, you want to also take the outlook because very strong guidance, right?
Well, definitely. And this is where I think a lot of the share price performance has come in. In the last 5 days itself, it's up 30% after the company reported its results. In the last month, it's over 60% returns. But that's because the company currently is at 3,660 crores in terms of revenue. And we discussed that in the income statement has grown very steadily. But the target in FY31, which is in the next 5 years, is to reach 19,000 crores almost in terms of revenue. And that's almost 6x of the company's current state. This will be, of course, led by the inorganic acquisition as well. The company is guided that out of the 19,000 crores almost in terms of revenue, 11,000 will be inorganic, which will be acquired companies, while the traditional business will continue growing at a steady rate. But essentially, Harsh, given this particular rating, it's almost 20% CAGR in terms of revenue. And when you look at margins, and you did discuss that, it's currently at 14%. The target over the next couple of years will be to reach almost 16% margins and subsequently increase that to 20% EBITDA margins for which is a very high number and a very strong number for an auto component and ancillary space. The other key aspect, and we'll talk about this with the management also, is the increasing of the alternate fuel percentage to 20%, but definitely the outlook is largely positive as well. Very strong numbers in terms of outlook going forward.
Right, so that's the outlook. Let's talk about street cred. Again, very impressive. 30% up in the last 5 days, or rather 35% up in the last 5 days. In the last month, the stock is up 71%. In the last 6 months, up 75%. Year-to-date period, the stock is up around 40-odd%. The 1 year, the stock has doubled. So keep your eye out on that. And it's been an 11-bagger from in the last 5 years as well. So it's been extremely strong performance from a stock price perspective. But what I'd want to know, therefore, is where do valuations lie, Puneet?
Essentially, in terms of valuation also, because the company does not have any current analyst coverage. So we're taking trailing price to earnings, which is 25 times currently, and largely in line with peers. We have seen an increase essentially in the price to earnings over the last maybe a couple of quarters where the growth momentum started to increase. But now going forward, I think a lot of view from the management will be key because in terms of growth prospects, they've guided for a very strong number, and I think the market will reward some of the key measures. And once they start, Harsh, looking at that aspect over the next 4 to 6 quarters, and that getting quantified, we would see a very strong valuation multiple as well, in line with the other peers, maybe trading close to almost 30 times going forward.
Okay, so let's quickly look at how this stacks up with regard to our KYC ratings. And when you're looking at the income statement, balance sheet, thumbs up, return ratios, thumbs up, cash flows, and neutral. Want to see more on that count? You're seeing shareholding is a thumbs up, street cred is a thumbs up. Outside of that, outlook and valuations are neutral. We're just being cautious here. 6.5 on 8 on our KYC ratings as a result. But of course, we encourage you to look at each metric independently as well, because you could well get a 7 on 8, but at the same time, valuations may not be favorable. So you have to look at all of those and make a very composed call. Let me bring on board Mr. Anmol Jain, who's the managing director at Lumax Auto, to talk to us about the numbers. Mr. Jain, you've posted a very solid Q4. Let me talk about Q4 first, because want to also understand sustainability of that on the slightly higher base that you now have. You've guided for 20%, you aspire for 20%. Can you do it in FY26 all the way through FY30?
So thank you for having me, and thank you for Q4 and FY25 comments. I think FY25 was a great year. You're right. We continue to maintain that we would like to grow at a 20% CAGR over the next 6 years. That has been inherent to our next midterm plan, which we just rolled out. There are 3 factors why we say we will grow at a 20% rate. The industry clearly is not expected to grow, and the sentiments are much subdued. Number one, we have a strong order book. And let's say, even if I were to look at the 25 to 30% of the order book, which will come in FY26, that itself on a base of 3,600 crores gives me almost close to a 10% organic growth. Number 2, our wallet share continues to increase. If I look at the top 3 customers, our growth in FY25 has been far more than their own volume growth in FY25. And that continues to be the trend based on new product launches and deeper penetration. And number 3, based on certain inorganic moves and certain SOPs of very nascent joint ventures, we will get the full year realization in FY26. And those will contribute significantly again to the revenue stream. So these are 3 factors why we are quite bullish on the FY26 numbers and outlook on the top line growth. Lastly, the aftermarket. We did have some setback because of external dynamics of the aftermarket. It was true for all tier 1 companies. We've seen a rebound. April numbers look encouraging. Q1 seems to be on track. We do expect a good double-digit growth in the aftermarket as well for FY26, and hence the consolidated numbers are looking positive.
Mr. Jain, a very good morning, and thanks so much for joining in today. I just want to take forward the point for the guidance specifically, because it's a very strong guidance coming in at a time essentially where we've seen the competitiveness in the auto ancillary business go up across other companies as well. Where is the current confidence coming from to meeting this guidance? And also you've acquired a couple of companies, IAC and Greenfuel, over the last 3 years. Is this also penciling in further acquisitions for you to meet that target in FY31?
So absolutely. I think if I were to give you a broader understanding of FY31 midterm plan, I think one of the theme is the 2020-2020. We continue to aspire to grow at a 20% CAGR, which would bring us, speaking logically, from a 3,500 crore base today to somewhere around a 10,000-11,000 crore revenue top line by FY31 if I were to continue growing at 20% CAGR. We do say that 15% CAGR growth is something which organically we can deliver on the back of what I just mentioned: deeper wallet share penetration, strong order book, as well as full year realizations of certain businesses. We continue to remain pretty bullish on our next inorganic steps. Nothing for FY26, but we are already engaged in evaluating multiple opportunities. But definitely for the next midterm plan of FY31, we do expect that maybe one or two inorganic further steps could be realized in order to deliver that 20% growth.
Mr. Jain, what's the ticket size for the kind of inorganic expansion you're looking at? Because if you're following this 2020 strategy, what I'm trying to get to is how do you maintain that 20% margin? You'll have to acquire companies which are margin accretive of sorts, or internally on the organic business, increase margins. So where do those margins therefore come from? Give us some perspective.
So it will be a combination of both. You're absolutely right. One of the filters for our inorganic growth strategy has been looking at companies which are margin accretive to the consolidated entity. We don't follow a strategy of getting into a low valuation business and turning it around. We continue to maintain a momentum that we will acquire good assets which are doing very well, which are a good strategic fit for the consolidated entity, and as I mentioned, are margin accretive. Now, this 20% EBITDA margin is, of course, not specific to a certain timeline. I always say that this is our aspiration. We aspire to inch closer towards the 20% EBITDA margin. As I mentioned, by FY28, which is 3 years from now, we do expect to double our EBITDA in absolute amount. And if I look at the 20% CAGR growth, we should be in the vicinity of, let's say, around a 15.5 to 16% EBITDA margin by FY28. So 20% is something which, again, will happen in the future, backed on both getting into acquisitions which are operating at a higher EBITDA margin than the current consolidated entity. And that was clearly visible and evident from the last two acquisitions, whether it was IAC or it was Green Fuel, both continue to operate at a higher margin, and hence it has pulled forward the consolidated margins of the company as well. And of course, having said that, the existing businesses continue to, as we increase the content per vehicle, as we start to move the 6% of our total revenues coming from future and clean mobility towards more like 20% of it, clearly the margin expansion will also happen on the current businesses.
Mr. Jain, just wanted to talk a little bit about the last point you mentioned, which is green fuel, as well as the alternate fuel space of 20% essentially. Now, green fuel largely coming in from the CNG space, and that's a space that's been growing steadily for all passenger car makers. How do you expect this to grow in terms of organic growth as well as in terms of the kind of products that you're offering to CNG makers? How is this differentiated versus, if you can talk a little bit about product portfolio as well, will that be also led by wallet share? Because the growth currently, I think for FY26, it's penciled in for around 350 crores for green fuel. Do you expect this to maybe grow by, maybe double or grow by 2.5x to meet that target in FY31?
So absolutely, I think as we're all aware, CNG continues to be a very strong deliverable in the passenger car market. I think the market leader, Maruti Suzuki, has made it public that they would like to create about 1 million units on CNG by 2030. And I think if you look at the past record, they continue to deliver on that. We've also seen a good traction with other OEMs like Tata Motors, Hyundai Motor Corporation towards the whole CNG acceptance. So this year for green fuel, clearly because of the full year realization, yes, your numbers are absolutely right. We are looking at around 300 crores order top line revenue with sustained EBITDA margins. Going forward, there are 2-3 strategies. Number one, we are right now on the delivery system, which is basically high pressure to low pressure. The entire delivery system is where green fuel is currently playing, which includes receptacles, it includes valves, and we are not on certain products, which we plan to get into by FY26, FY27. Thereby, our value content per vehicle will significantly increase on the green fuel part. So number one would be the strategy would be to increase the value per vehicle, and number two, expand our wallet share. Currently, we are very strong, let's say at Maruti Suzuki, and again, we would like to expand our wallet share in other OEMs as well. So as a combination of that, yes, definitely I do expect a 2.5x growth in green fuel revenues over the next 5 to 6 years on the top line.
So Jain, just one follow-up, because CNG, I think currently Maruti is roughly about 8% of your revenues right now, with Mahindra being the top share, with followed. So it's Mahindra in the top, then it's Bajaj, and then Maruti, if I remove the aftermarket. So essentially the last year growth has been very slow for all automakers except in the passenger car space except Mahindra. So the CNG part of the business, how will that grow? Are you taking share from the existing players who are maybe contributing to Maruti? And I'm not sure if you quantify this number. Do you expect the share of Maruti to essentially double for your FY31 target?
So in terms of the order book, if you're sitting on, I mean, we're looking at almost 1,300 crores of order book, which the company is sitting on. And you're right, the Maruti share of business today at a consolidated level is about 8 to 9%. But if I look at the FY25 performance by itself, I mean, I think Maruti by themselves grew at about close to 6 to 7% in terms of numbers, but our revenue with Maruti grew by almost close to 20%. And that's again because of wallet share expansion across our product categories. So Maruti's contribution will not come just from green fuel, but there are other businesses like the gear shifter systems, which is heavily dependent on Maruti. We are about an 80% wallet share of Maruti Suzuki for the gear shifter systems of automatic as well as manual shifters. So it's a combination of different diverse businesses which will expand our wallet share and certain new products which we will be getting into, which cumulatively will definitely increase our dependence on Maruti Suzuki. But you're right, Mahindra continues to be the number one customer for Lumax Auto Technologies, largely because of the IAC footprint.
Okay, thank you so much, Mr. Jain, for coming and speaking with us. That's unfortunately all the time we have, but wishing you all the very best for FY26. It's a very impressive guidance that you've given, and wishing you all the very best all the way through FY31. Of course, we'll continue to interact with you in the interim as well. But with that, completely out of time on this edition of KYC. From Puneet, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.